It is February 11th, 2026. And, if you were only read the technical headlines this morning, you'd be forgiven for thinking we were in, the greatest bull run in history.
Oh, absolutely. We've got blockchains announcing transaction speeds that make Visa look like a dial-up modem.
Exactly. We have AI agents paying each other in digital currency without a human anywhere in the loop. I mean, the engine of this industry is just objectively faster, more powerful than it has ever been.
And yet, if you look at the price charts or, more importantly, the flow of actual dollars, it looks like everyone has just quietly packed their bags, turned off the lights, and left the room.
That is the massive contradiction we are staring at today. The tech is breaking the sound barrier, but the market is rolling backward.
Right.
So the mission for this deep dive is to solve that riddle. We have a stack of sources that is, it's a bit of a schizophrenic mix. We've got these dry institutional filings from the SEC, earnings reports, some leaks from a very tense White House meeting,
And a technical white paper that is making some, frankly, impossible-sounding claims. It really is a collision of two worlds. You got this boring, heavy financial reality crashing into these, high-octane technical promises.
And the question is, which one is real?
Mm-hmm.
Exactly. So let's start with the boring stuff, because that is where the money is moving, leaving. We have the latest Form 13F filings from Goldman Sachs. This is the smart money everyone always says to follow. So what are they doing?
They are risk managing, and they are doing it pretty aggressively. Goldman filed their 13F on Tuesday, covering the fourth quarter of 2025.
Okay.
Now, usually these are just routine, but this one had a very stark headline number. Goldman dumped about 39.4% of their spot Bitcoin ETF holdings.
Wait, nearly 40%? That's not just rebalancing a percent or two?
No.
That feels like a statement.
It is a statement.
Yeah.
But we need to be precise about what that statement is because, headlines can be misleading. They didn't exit the market.
Okay, so they still have skin in the game.
A lot of skin.
Mm-hmm.
They still hold roughly 21.2 million shares across various Bitcoin ETFs. That position is valued at about $1.06 billion. So they are very much still at the table.
Okay, so they haven't folded, but they took a massive amount of chips off the table. And they did this during Q4 when prices were already softening. I mean, usually the mantra is buy low, sell high.
Right.
This looks a lot like sell low because you think it's going lower.
That is a very fair assessment. It signals their internal models see further downside risk. And it wasn't just Bitcoin. They also trimmed their Ethereum holdings by about 27%.
So it's a broad risk-off move.
It was. But, and here's where the data gets a little weird, while they were selling the blue chips, the filings show they actually opened small starter positions in XRP and Solana ETFs.
Hang on, that seems completely counterintuitive. Why would a bank that's scared of risk sell the safe assets like Bitcoin and Ethereum and then go buy into higher beta, riskier assets?
It does seem contradictory on the surface. But in institutional portfolio management, this often signals a shift from, say, accumulation to speculation, or maybe hedging.
So the dollar amounts were small.
Tiny. Tiny compared to their billion-dollar Bitcoin bag.
Mm-hmm.
They're likely just testing the liquidity of these newer ETF products or, maybe hedging against a specific narrative shift.
So they're dipping a toe in.
Exactly. But don't let the small buys distract you from the big sell. The overarching signal from Goldman is caution. They are raising cash.
Okay, so the institutions are cautious. The suits are stepping back. What about the retail crowd, the everyday people on their phones? We have earnings data from Robinhood, and honestly, the picture there looks even bleaker.
It is a bloodbath for crypto engagement. I mean, Robinhood reported record total revenue $1.28 billion, which sounds great on its own.
Right.
But that was driven entirely by stocks and options.
Yeah.
If you look at the crypto bucket specifically, revenue fell 38% year over year.
That is a massive drop.
Oh, it gets worse. Trading volumes on the app collapsed by 52%.
52. So literally half the activity just evaporated.
Gone. And Robinhood is the perfect proxy for the average investor. When you see stock trading going up on the same platform where crypto trading is dropping by half.
It tells you where the attention is.
Exactly. The retail attention span has snapped. They aren't just holding, they're ignoring the asset class entirely. They've moved on to NVIDIA or whatever the hot stock is.
It creates this feedback loop, doesn't it? Goldman sells, prices drop, retail sees the drop, gets bored or scared, and stops trading.
Precisely. It's a fear feedback loop.
Mm-hmm.
And without that retail volume to absorb the institutional selling, the price action just feels incredibly heavy. It's like trying to run through mud.
Yeah. Any little rally just gets squashed.
The rolls right back over.
Well, adding to that mud is the regulatory situation. We had this high-stakes meeting at the White House recently, crypto firms versus the big banks. The topic was stablecoins. I assume, given the mood, they didn't exactly hug it out.
No deal was reached. And this is a critical headwind that I think people aren't paying enough attention to. The core friction here is actually quite simple, but it's fundamental to how banks make money.
Which is?
The banks are lobbying furiously for a ban on stablecoins paying yield.
Okay, let's break that down. Why does a bank care if my digital dollar earns me 5% interest?
Because of their net interest margin. Think about it. If a stablecoin pays you 5% just for holding it in your digital wallet and your Chase savings account pays you, 0.01%?
I'm moving my money to the stablecoin, obviously.
Right. That is what the banks call deposit flight. They rely on your cheap deposits to fund their loans and mortgages. That's their entire business model. If stablecoins become high-yield savings accounts, the banks view that as an existential threat.
So they want to make sure stablecoins stay dumb, just digital cash that sits there.
Exactly. Payment instruments, not savings instruments. And until this gets resolved, the big capital is just stuck on the sidelines.
Which brings us to the Clarity Act. I was reading Paul Barron's analysis on this, and he calls it the trigger moment. He's basically saying the market isn't waiting for a price target, it's waiting for a law.
That's the consensus among the macro analysts. The big players, your BlackRocks of the world, they're not going to make massive aggressive moves while the rules are still being written. Barron points out that the poly market odds, the betting markets, show it's basically a coin flip, 50-50.
A coin flip on whether the Clarity Act passes in 2026? That's not exactly reassuring.
Not at all. And you have this tension where the Trump administration reportedly wants it signed quickly, maybe within weeks, to secure U.S. leadership. But the banking lobby is pushing back just as hard.
So we have a stalemate in Washington, a sell-off on Wall Street, and total apathy on Main Street. It really does explain why the charts look the way they do. It's not a crash, it's just stuck.
It's a deadlock.
But we have to pivot, because while the money is stuck, the technology is apparently going ballistic. This brings us to the speed of zero.
This is the paradox, right? While everyone is gloomy, we get this white paper for a project called Zero and the ZRO token. And the claims here are, honestly, they sound like marketing fluff at first. They are targeting 2 million transactions per second.
2 million. Okay, just to ground us here, what does Visa do?
Visa handles about 24,000 transactions per second at peak capacity.
So Zero is claiming to be nearly 100 times faster.
Yeah.
Okay, I have to be the skeptic. Usually when a blockchain claims that kind of speed, there's a catch. The blockchain trilemma, you lose security or decentralization.
Right, you basically become a centralized database.
Right.
But they claim they're solving it by fundamentally changing how the work of the blockchain is done. The source uses a really effective analogy, the accountant versus the auditor.
Okay, walk me through that.
So in a traditional blockchain like Ethereum, every node, let's call them accountants, has to do all the work. A transaction comes in. Thousands of accountants all pick up their calculators and verify the math.
Which is incredibly secure, but redundant.
Yeah.
And slow.
Highly redundant and slow. Zero changes the model. Instead of everyone doing the math, one person processes the transaction and generates a cryptographic proof. Think of it like a verified receipt.
And the other nodes?
The other nodes don't redo the math. They just look at the receipt and verify the seal is unbroken. They become auditors, not accountants.
So they're verifying the result, not repeating the process.
Exactly. Checking a proof takes milliseconds. Doing the calculation takes time. This architecture allows them to run what they call zones, parallel applications, running at the same time without clogging up the main artery.
It sounds impressive, and the Zero token is actually moving up on this news, even in this market. But they also took some shots at Ethereum, didn't they?
It was definitely aggressive. They explicitly criticized the Layer 2 roadmap that Ethereum is using. They argue that building layers on top of layers just fragments the user experience and liquidity.
So their pitch is one super fast layer for everything.
A monolithic high-speed layer. Yeah, it's a bold pitch.
But I have to ask the obvious question again. If we have a highway that can handle 2 million cars per second, but, as we just discussed with Robinhood, the retail drivers have left the building, who is driving on this road?
That is the multi-billion-dollar question. Right now, it feels like we're building infrastructure for a ghost town. Why do you need 2 million TPS if you only have 500 users a day?
Which leads us nicely into the cycle discussion. Is the town abandoned forever, or is everyone just on vacation? We have analysis from Benjamin Cowan, who is known for being, let's say, realistic.
He's not a moon boy, no. Cowan is very data-driven. His thesis is that we're suffering from what he calls time capitulation.
Time capitulation, what does it mean?
It means people can handle price drops. They can buy the dip. What they can't handle is time. Months of just nothing. chopping sideways. He points out that historically, Bitcoin tops out in Q4 of the post-halving year, which was like 2025.
So we are right on schedule for the hangover.
Yeah, exactly. We're now in February 2026. This is the apathy phase. Cowan's point is we shouldn't look for some grand conspiracy to explain the drop. The market is dropping because people have simply stopped caring.
Which aligns perfectly with the Robinhood numbers we just saw.
It does. And his timeline is tough for people to hear. He expects weakness through the first half of 2026. He says we might see a bounce in March, but then the classic sell in May kicks in. He argues that a true durable recovery might not happen until 2027.
2027, so that effectively kills the supercycle theory that we just go up forever.
Cowan says the supercycle is dead. You can't force a summer when it's winter. The market needs to cleanse itself of the hype before it can rebuild.
Okay, a long winter ahead. But, and this is the final piece of the puzzle, under the snow, things are sprouting. We saw some specific adoption news with Stripe and AI that connects back to that whole speed issue.
Yes, this is the rapid-fire adoption that doesn't show up in the price, but it's probably the most important signal for the long term. Stripe just rolled out Buy 402 integration on Base.
Buy 402 sounds very cyberpunk. What does it actually do?
It enables machine-to-machine commerce. It allows AI agents to pay each other in USDC and stablecoins instantly.
So practically speaking, my AI assistant could book a flight for me and pay the airline's AI agent directly with no credit card, no bank delay.
Correct. And this is why that zero speed we talked about matters eventually. Humans can't click fast enough to need 2 million TPS or slow, but millions of AI agents conducting microtransactions, they will absolutely need that bandwidth.
That's a fascinating disconnect. The price is driven by bored humans, but the utility is being built for hyperactive robots.
And for institutions. We also saw Franklin Templeton and Binance allowing tokenized money market funds to be used as trading collateral.
Translate that for us. Why does that matter?
Right now, if you want to trade, you often have to leave cash sitting in an account doing nothing. It's dead capital. This change lets big players keep their money in a government bond fund earning 4 or 5%, but use a digital token representing that fund as collateral for trading.
It makes capital efficient.
It makes capital efficient. It's boring plumbing. It's not going to make a meme coin pump. But it is exactly the kind of infrastructure BlackRock and Goldman need to feel comfortable deploying billions.
And briefly, we also saw Tether investing in Layer 0.
Yes, and just to be clear for you listening, Layer 0 is different from the Zero blockchain we just discussed. Layer 0 helps different blockchains talk to each other. Tether investing there just means they want their stablecoin, USDT, to flow seamlessly everywhere. It's another piece of the plumbing.
So let's try to synthesize all this. It's a confusing landscape.
It is. On one side, you have the old guard Goldman, the banks pulling back risk or fighting for regulatory control. On the other, you have retail completely checking out because the easy money is gone.
But underneath all that, you have Zero building a Formula One track, and you have Stripe building the AI agent cars to race on it.
That's the perfect summary. It's a construction phase disguised as a recession. The windows are boarded up, the sign says closed, but inside, they're rewiring the entire building for fiber optics.
And the question is, do you have the patience to wait for the grand reopening? Or does that time capitulation get you first?
That's the bet. If you believe the traffic is coming, the AI traffic, the institutional traffic, then this empty highway is an opportunity. If you think the traffic is a myth,
then it's just a very expensive road to nowhere.
A very fast, very expensive road to nowhere.
A lot to chew on. We'll be watching those 13F filings, and we will definitely keep an eye on that Clarity Act.
Indeed. Watch what they do, not just what they say.
Always. Thanks for helping us break this down. And for you listening, stay curious, don't let the boredom fool you, and we'll catch you on the next deep dive.